and welcome to this evening's webinar, AAII and Better Investing, Building Wealth with Small Cap Stocks. We'll give everyone a second here. While we're waiting, I want to thank everyone for joining us. We're happy to have you all here. So my name is Susie Artsberger, and I'll be your host tonight. A few things to go over before we begin. I want to remind all our webinar attendees that both AAII and Better Investing are nonprofit educational organizations and are not financial advisors. Therefore, we are not able to provide personal advice. Every investor is different. That's why our goal with each broadcast is to educate you on how to make better financial decisions. So we have two great speakers tonight, Doug Gerlach from Better Investing and John Bykowski from AAII. I would like to thank both of you for being with us this evening. And in this presentation, Doug and John will share how their organizations approach small cap investing to help individual investors uncover long-term opportunities. Specifically, Doug will introduce the SmallCap Informer, Better Investing's newsletter focused on identifying high potential small cap stocks using its proven quality growth at a reasonable price strategy. John will highlight AAII's model shadow stock portfolio, a value-based strategy focusing on small and micro cap stocks. They'll also show how to identify promising small cap value stocks using AAII screening tools and A through F grades. To you, our attendees, be sure to keep an eye out on the chat throughout the webinar, as we'll be sharing helpful resources, key insights, and other relevant links and resources. During the presentation, if you have any questions for our speakers, please send them using the questions section of our GoToWebinar control panel. Once the presentation concludes, I'll select a few questions for Doug and John to answer. And if the question isn't answered during the broadcast, feel free to email members@aaii.com or service@betterinvesting.org. If you experience any issues with the audio or video of the webinar, please visit the GoToWebinar support at gotowebinar.com for assistance. And just a friendly reminder that this presentation is being recorded. If you have to leave for any reason, you'll be able to replay the whole event. A link to that webinar replay will be sent to all attendees later this week. And the recording will also be accessible at aaii.com/webinars or youtube.com/betterinvesting. So we love that our webinars are interactive. After the presentation, we'll host a live Q&A, including two special promos from AAII and Better Investing. And so please be sure to stay for the entire broadcast. And with that, I'd like to hand the presentation over to Doug to kick us off.
Thank you, Susie, and good evening, everyone. Welcome. Glad you could join us tonight for this educational presentation. I'm going to be kicking off talking about small company investing for long-term investors. As part of Better Investing, our approach to individual stock analysis is based in the benefits of buy and hold for the long term. And we've applied that in our small company stock newsletter, and I'll talk about that approach as we go through. This is our disclaimer. Of course, this is an educational presentation, and we will be discussing particular stocks during the presentation. These are not recommendations. We always recommend that you do your own due diligence and research before making any investing decision. Now, as part of Better Investing, our little subsidiary that I head up publishes 3 investing newsletters. Our flagship is the Investor Advisory Service, a newsletter that was founded way back in 1973. It's been named to the Holbert Investment Newsletter Honor Roll for 15 consecutive years for outperforming the market in both bull and bear market cycles over the long term. In 2013, 2012, we started the SmallCap Informer using our long-term approach to target smaller companies. And in 2023, we founded a dividend newsletter focused on dividend growth and capital return, not necessarily yield. But we're going to be talking about the SmallCap Informer tonight and the things that we've learned in the 12 plus years since we started the newsletter. Now, this is a monthly newsletter for to present small stock ideas for individual investors. We use a disciplined methodology that looks at quality companies, trying to attempt to purchase them at reasonable prices and generate above average total return prospects compared to the broader small cap indexes. We do utilize a long-term buy and hold strategy. That does not mean buy and never sell. It is part of our methodology to monitor the fundamental performance of companies along the way and make sell decisions when necessary. We have outperformed the S&P SmallCap 600 index over the long term since we've started the newsletter, and I'll show you that track record in a moment. Here's some sections of the newsletters. As you can see, this is a traditional print-based newsletter. Most of our subscribers elect to get it electronically, which means they download the issues when they're published and they can print them or read them on their tablet or computer. This is our track record since the newsletter was founded. We've had a great run this year, especially since August, as the small cap markets have kind of turned around and reversed the trend, and we've seen a number of companies performing quite well. But our long-term 3-year and 10-year performance way outweighs the performance of the S&P SmallCap 600 index. Yes, compared to the returns from the Magnificent Seven or any broad market index, the S&P 600 has not been delivering exemplary results, but it's our belief that sector shift will happen at some point and we'll see small caps coming back into dominance. The benefits of small cap stocks from Better Investing's perspective are quite good. They suggest that 25% of an individual investor's stock portfolio is devoted to small company stocks. This is because both small and large company stocks tend to perform at different times in the market cycle. And as we all are probably aware, small company stocks have historically bettered the performance of large caps over the long term, recent history notwithstanding. So the methodology that we employ in the SmallCap Informer, first and foremost, we're looking primarily at companies with annual sales between $100 million and $2 billion a year. This is a pretty small segment of the broader market. We do continue coverage as companies perform well and exceed that. So we do have some of our top performing companies have grown beyond that 2 billion mark, and we still carry them in the newsletter. We don't make new recommendations for those companies. And we do also occasionally track companies that have annual sales below $50 million, which is really in the what we consider the micro cap space. You'll see more of those, I expect, when John presents later on about some of the AAII tools. We are open to any sector and industry in our coverage. But in practice, we rarely find utilities and energy companies that fit the model. Companies must be profitable. That is a key criteria. Typically, we like to see at least 3 years of operating history. So there might be a newly public company if we feel like we can purchase it at a reasonable valuation. But otherwise, the companies have to be demonstrating that they're able to generate earnings. And that will be the baseline that we're going to support use to support our future growth projections. Now, our approach we call Q-GARP, which is based on the growth at a reasonable price methodology that Peter Lynch popularized back in the 1990s. But we really felt like that didn't tell the whole story. We have a focus on quality. And when you're investing in smaller companies, those quality metrics become quite significant. So we appended or prepended the Q to GARP to come up with Q-GARP. We do use the Better Investing Stock Selection Guide, or SSG, as a starting framework. If you're unfamiliar with that tool, you can look back at the recording of our first webinar that we did with AAII, and we reviewed some of the precepts of that stock selection guide, and there are plenty of other resources. This is an analysis tool that is used to identify growth, quality, and valuation metrics for a company. So we'll start with the Q-GARP. We'll start with the growth criteria. Of course, we like to see sales growth, and sales growth is required to drive earnings growth. And earnings growth is required to drive long-term capital appreciation, which is to say that if we find companies that consistently increase their earnings per share, that have significant tailwinds in place to drive future performance, then eventually, ultimately, the share price will catch up with that growth. In the short term, of course, anything can happen. In the short term, markets behave irrationally, and that provides an opportunity for us, in many cases, to purchase undervalued or underappreciated securities. But we do require growth. In our framework, however, because of our bias towards reasonable price or reasonable valuations, we're not looking at high-flying growth companies. We skew more towards small cap value. And so our baseline minimum growth estimate for any company has to be around 8% or better. Yes, we love to find fast-growing companies, but often those are way too expensive for our Midwest ethos to absorb. And when you overpay for companies, you increase the risk in your portfolio and the potential that your returns are not going to meet your objectives. The growth trends provide a base of analysis. They are not the be-all, end-all. We're not looking at the past performance to judge future performance by, but we are looking at what are the components of that growth. What has caused this company to grow at this particular rate? What are the tailwinds and headwinds? What are the drivers? What are the obstacles the company is likely to face in the future? And that will allow us to confirm that this is a company worthy of consideration or eliminate it as one that doesn't meet our criteria. This is a good example of a company that has been growing for a decade. It's been growing at a very consistent level. On the top are the revenues or sales. The blue line is the earnings per share, and you can also see the high and low annual prices indicated there. And on the 2025 year, you can see the current price midway between the high and low of the last 52 weeks. This is Addus Home Care. This is an Illinois-based company that provides home health care services. So you can see a little bit of variability in their earnings and certainly in their valuation during different cycles of the economy and what's going on with regulation related to Medicare and Medicaid. But all in all, the company has weathered the storm quite well, and growth is expected to continue. That average growth over the 9-year period is 15.4% for sales and 18.9% for earnings. So this is a little bit of a faster growing company than many that we track. Here's another company that has somewhat less consistent growth, but you can see over the last few years, this company has been growing more consistently, and that's what we like. This is Palomar Holdings. Ticker is PLMR. This is a property and casualty insurance company. However, they focus on some different areas of the market that aren't going to be as impacted by the terrible weather in Texas or Florida, for instance. And that allows them to have a high quality portfolio and are definitely growing the business, as you can see on this graph. And this is a good example of a company where we might look back and say, well, what happened 5 years ago or 8 years ago to this particular company? We see some earnings shortfalls, but the bottom line is that they seem to have ironed out those problems. So we like that. And when you see the price here, the price bars, you can see that in 2023, the price dipped down, even though earnings and revenues were growing. And that became a good opportunity and entry point for us, we felt, in order to benefit from that mismatch of price and fundamentals. Now, I've spoken a lot about the value formula, the reasonable price criteria. It is so important whenever you're investing in individual equities, but especially with small cap stocks, to be rigid and focused and have a good discipline when you're making those buy decisions. We look at the PE ratio and expect it to be reasonable when compared to the history and the future expectations of growth. We do avoid high flyers. So PE is greater than 30 or 35 tend to be set aside, and we will wait for that valuation to fall down a little bit, and then maybe we'll have a better opportunity to purchase. We are often contrarian in that we seek out those mismatches between what the market thinks a company's worth and what our estimate may be. And again, that focus on fundamentals, that focus on the long term, when the rest of the market is worried about what's going to happen next week or next month or next quarter, we're thinking about what's going to happen after the dust settles and the company is into its next growth phase. And that gives us opportunities. We've often found that it is more advantageous in the small cap side to focus on value as opposed to growth. It's relatively easy to find small companies that are growing at 30%, 40%, 60% a year, but there's simply too much risk involved for us to be enticed by those companies. Here's a graph of the 10-year PE ratio history of a company, UFP Technologies, ticker is UFPT. You can see what's interesting is that this is the annual high and annual low PE ratios. So you can see that the stock essentially moves in a band, almost like a price band. And sometimes that PE ratio takes off and sometimes that PE ratio falls. But by and large, that variance between the high and the low is at a particular range. I've marked on the right side the current PE of this particular company. So it is pulled back in price. And again, we see that as an opportunity. The current PE is close to the lowest PE of the last 52 weeks, and it's also of the prior fiscal year, and it's also not too far out of the range of the lowest PE ratios the stock is traded at on an annual basis. So again, a good example of a value formula coming into play. This is a real estate investment trust, so it is a newer public company. So we have data going back to 2019. Valuation very different for REITs than for operating companies in many cases. Here we're seeing the high PE ratio, or actually high price to funds from operations ratio on the high side and the low side. And again, that current PE ratio attractively currently sitting near last year's low PE range. So that gives us plenty of opportunity on the upside. So we like looking for those types of opportunities. And then we come to quality, perhaps the most important and maybe the most distinctive of our approach to small company stock investing. It's our belief that effective management is required to deliver consistent growth. Companies that are growing at a fairly consistent pace year after year after year means that management is paying attention to all of the moving parts that go into running a business. But beyond that, if we find companies that meet our key quality criteria, we see that these companies tend not to be over leveraged. They may carry debt. They may be slightly higher than their own industry group, but their cost of capital is reasonable, for instance, or the trends are good. They're generating free cash. They're paying off that debt. They may be opportunistic with their borrowing to make acquisitions, but diligently pay it down. So debt is not a four-letter word for us. If they're paying dividends, they tend to be well supported by cash and earnings, and cash flow generation is always good. We like to see that. But the real story comes with the pre-tax profit margin analysis. And so we focus on pre-tax profit margin. That takes out the impact of share buybacks, which have become an increasingly common tactic for companies to utilize to boost their earnings by buying back shares instead of paying out dividends. But if we do the pre-tax margin, the pre-tax profit margin analysis, that kind of equalizes the impact of companies that are buying back shares and that are not buying back shares. It also provides a little bit of a baseline to compare ADRs, or foreign domiciled companies, where the tax rate they pay is different than a U.S. tax rate. If we look at the pre-tax profit margin for both of those companies, we take out that tax impact as well. So we see companies that are expanding their margins. That's great. That's very difficult to do with everything that's going on in the economy, with inflation, with tariffs, and the cost of goods, cost of labor, cost of marketing. Companies that are able to increase their margins, management, it must be doing a pretty good job there. So, and then those companies, once we've identified them by the superiority of their margins, as we start looking at the rest of the balance sheet and the income statement, we see that they're just working the business optimally. And so you don't have to spend a lot of time looking at all the other financial ratios. It's really a shortcut. And that's the secret sauce that goes into our approach. Here's a graph of the pre-tax profit margin. So that's the percentage pre-tax profit to sales for semiconductor company Fabrinet, ticker FN. And on this graph, the black line is Fabrinet, and the blue line is the industry average. And you can see Fabrinet's margins just expanding and expanding pretty consistently, while the rest of the industry is trailing behind as they adapt to market conditions and demand. But we like to see that when we see companies that are doing better than the major players in their industry, perhaps, or the average of their industry group and peer group. We find that those are admirable companies that we want to be owners of. Here's another example: Powell Industries, electrical equipment. And again, the black line is their business, their margins. The blue line is industry averages. So you can see, these industrial companies, these electrical equipment makers like Powell, often are seeing their margins kind of drift downwards. The reliance on imported goods and parts makes it difficult when we've got tariffs and costs are going up, but doesn't impact Powell. In fact, they're finding new ways to become profitable. So we like that about this particular business, and this is the kind of trend that we like to see. So our total return objectives, primarily we're looking at capital appreciation as long-term owners of companies. We're looking at earnings growth to drive the share price over time. Many companies pay dividends. We do have some yield payers in our coverage list of about 40 companies, and so that will contribute. And then when we have the opportunity to benefit from PE expansion, that is to say, buy those shares when the PE ratios are low, then that will contribute as well to our total return. And altogether, this is how we hope to exceed the averages for the market. Now, I do want to point out a couple of the kinds of companies that we avoid. If it's an unprofitable business right off the bat, we may put it on the watch list and wait for profitability to arrive, learn about the company, get to know it. But simply because the company has a great story, simply because it has a share of headlines in the media, does not mean that it is a good business that we should consider investing in. We tend to avoid companies that have longer-term downtrends of sales and earnings. If those companies are in our coverage list, we don't let them go for too long before we discontinue them. We avoid turnarounds. We do sometimes embrace fallen angels, but those can be very difficult. Wall Street tends to remember much longer the failures of companies rather than the successes. And so even once the company turns around their fundamentals, we tend to see the market stay away from those companies. We tend to avoid hypervalued stocks. These are stocks at the excess ranges of the overvaluation, where mania and the fear of missing out and other trends are driving the share price. It's not just driven by fundamentals. And again, we find those problematic for the risk that they embody in a portfolio. And penny stocks, and for the most part, micro caps, we avoid as well. We have, in each issue, we focus in depth on one company. That's our buy recommendation. Other than that, we do not automatically recommend any stocks as buys. We function as a research service. We don't have a model portfolio. The objective is, here is a stock you might be interested in. Here's the case for why you should consider it. If it meets your portfolio objectives for diversification and growth, capital appreciation, total return, dividends, etc., then you might put it on your watch list or pick up a few shares the next time you're looking at your brokerage account. We do have in each issue a best for new money category where we pull out those stocks that may have seen their price trip up a little bit, and we see them as good long-term buys at that reduced valuation. So that is the first place that subscribers go if they've got cash that they want to deploy. That's the resource they can look at from there. We aim to hold stocks for 4 or 5 years and through market cycles. That is our strategy. We don't time the market. We don't sell when we expect the market may decline. I don't know how people figure out that the market is going to decline. Nobody seems to have been able to do it successfully. So we're going to hold through and ride the market cycles up and down. Laggards are pruned. That means companies that are not performing fundamentally, and we do strive to get in sooner rather than later. Often we're susceptible to the same cognitive biases that affect all investors, where you say, well, let's just give it another quarter and see what happens. But we do discontinue companies on a regular basis. The oldest stock that we have under coverage right now is 2014. We did cover Air Lease starting in 2013. They just announced that they were being acquired, so we discontinued coverage. We had, I think, the initial recommendation and 3 follow-on recommendations over the course of a dozen years, and we're able to successfully exit that position. We have 73 open positions of 40 stocks. And that is to say that after a year, we may revisit a stock and say, yes, this stock is now in the buy zone once again, or it's still in the buy zone. And so we will recover it from that perspective. Otherwise, we're covering quarterly earnings of every company under coverage, as well as other major news. And when it's warranted, we're going to recommend sells. We've got an on probation list as well. That's our strategy for companies that are fundamentally seem to have some potential problems, but we don't want to jump too quickly if a company's got a temporary problem. So it's a fine balance between identifying what's a temporary problem and what's a fundamental shift in a company's business. So we have an on probation list where we'll move stocks over and say we wouldn't recommend buying unless you're exceptionally risk adverse, unless you've got capital that you really are willing to take a chance on these companies. They could turn out to be duds. Maybe they will recover and they will have some major returns. One of the companies that was on our on probation list until recently for several quarters was the discount retailer Five Below. But the last couple of quarters have been very strong as they've revamped their management team, and that company moved off of our on probation list and back into regular coverage. We also have a valuation watch, which is to say these are companies that we perceive to be hypervalued. If you are worried about the downside, you might consider using trailing stop loss orders to catch them if they do go into a sudden reversal. If you are interested, if this sounds interesting to you, you can get a free taste of the newsletter with our Small Cap Reflections email that comes out about once a month. Provides some commentary, some outlook on the small cap markets, occasionally talks about companies that we cover or have covered, educational and focused primarily, but it's a good way to keep up to date with the performance of the full newsletter, and so you're invited to do that. You can find it on the smallcapinformer.com website, and if you are interested in a full subscription, the promo code AAII or the promo code BETTER will deliver maximum savings. And special offer for the next month, so until October 21st, there's an additional discount on the AAII price. It's usually the newsletter is $249 a year. The AAII discount is $145 a year through October 21st. So if you jump on it this week, it's $95 for that year. So that is a bargain for the performance that you're getting and the insights that we hope to deliver in that small cap product. So with that, I hope that you've gained a better sense of perhaps how small caps can be deployed in your own portfolio. So I'm happy to turn it back over to Susie and to John to tell you more about using small caps to invest as individual investors.